I believe that real estate is the number one vehicle, right, for wealth building, for tax deducting, and wealth building. Or did I say wealth building twice? Yeah, wealth building.
Wealth building is kind of important, it sounds like.
Oh, yeah. Well, I believe that, here's an interesting thing that ties with real estate. Rich people pay taxes, wealthy people don't.
There you go.
That's just what it is. So you own a bunch of real estate and you're really wealthy, there's a very high likelihood you don't pay taxes. There's a very high likelihood.
Welcome to the Uncensored Real Estate Podcast, where nothing is off limits. If you're interested in buying, selling, or investing in real estate, and you want to learn some of the insider secrets and uncensored truths from the true professionals in and around real estate, you've come to the right place. Now, let's buckle up for the uncensored truth about real estate and join your host, Brian Cardenas.
All right, everybody, welcome again to the next episode of the Uncensored Real Estate Podcast, where nothing is off limits. And today we're going to take a little bit of a left turn into getting into the nitty-gritty of real estate and what are some of the real beneficial aspects of real estate when it comes to taxes. Now, I know everybody thinks taxes, oh my God, I don't want to hear about it, but this is actually going to make you money. So you're going to want to tune in here. We brought in a very special guest today, David A. Perez. He's the CEO of Tax Plan Experts, to educate us on all things related to business strategies, tax planning, and real estate. David, thanks very much for joining us today.
Hey, thanks for having me, man. I'm excited.
Absolutely. Yeah, man, you can say whatever you want.
All right, that's what I'm talking about.
Although I probably won't give any tax advice because, I'm not gonna step there. I'll let you do that. So do me a favor. Give us a little bit of background on you. Kind of where did you come from? How did you get where you're at today?
Well, I can go real far back, but I'm going to start when I got into real estate. So I got into real estate back in 2006 as a realtor, thinking that this was my future. I had ambitions of owning real estate one day, but I really didn't have the money or the resources or the family or the credentials to actually do it. So I thought becoming a realtor would be a really good start to the process. And in 2006, late 2006, I get my license. And for about a year, I'm trying to feel myself out, trying to learn things. I would do like phone duty and, realtor open houses for other realtors because I didn't have listings. I mean, I was young. I was in my early 20s. And in late 2007 and 2008 is really when everything shifted for me because the market crashed. And when the market crashed, everything that I thought I wanted to do was kind of gone. I mean, I wasn't a rock star agent or by any means, but that was my future. And so I get to 2008 and I'm like, crap, what am I going to do? So I started working for banks in the repossession process. I would do these things called brokers of professional opinions. And I literally did probably thousands of these things where I'd go to homes and of people who were in like preliminary foreclosure, and I'd look at these houses and give valuations. I didn't enter the homes. It was more outside and neighborhood look and all these things. And so as I was trying to figure things out, a buddy of mine reached out to me and he said, hey man, I know you've got, a little struggle with the real estate business. You mind maybe helping me out, maybe going into the tax business with me? And I said, tax business, what's that? And he said, preparing income taxes. And I thought, I don't really want to do that. At the time, I thought this is stupid because to be truthful, the only thing I knew about taxes at the time is that I didn't like paying them. I mean, that's the only thing I knew.
That's pretty unique perspective there.
Yeah, that's all I knew, man. So he said, this is a good industry. You should check it out. And so I went to, this was to get into a franchise that did taxes. So I went with him to a discovery day and I sat through this discovery day presentation, not really caring about it. I was just there with my buddy because he said he's going to buy some drinks afterwards. And so, hey, I'm transparent, right? And so a guy gets up on the kind of the front of the room and he starts speaking and he says, hey man, if you guys don't get anything out of this presentation, just get this one thing. And so I'm there. Okay, let me hear what he's got to say. And he says, the tax industry is recession proof. And I thought to myself right there and then, like, wow, okay, this is a different perspective for me because I was in the real estate industry and it had just gotten shocked, right? I mean, it got kicked in the nuts, if you mean,
Yeah, for sure.
And I was losing everything that I had thought I was going for. So I decided to take a leap of faith and I entered into the tax industry in 2008. It was my first year. I've been in there since I've been preparing taxes since then. And really what changed for me is when I got into the business, I was really good at, I realized I was very good at marketing and sales. It's one of the things I'm really good at. And that showed because in my first year, we did over 800 returns or 800 clients we served. And that's pretty impressive for being new to the business, never really knowing anything about taxes rather, but just learning a system and following it. And so my goals and aspirations were literally to help thousands of people file their taxes over the course, as long as I could do it. And so from 2008 to 2015, I had one office. And then because we're kind of retail, we're just doing tax prep. I went up to 15 locations. We were doing about 7,000 tax clients every year.
Wow.
And we were one of the largest tax professionals in the state. And we were doing really well. And in 2015, everything changed for me. It was the year that I had my first largest tax bill. And it was March of 2015. I'm reviewing my tax return, which, by the way, you never really want to do your own taxes to begin with. So we hired a CPA that would do our taxes because obviously you get some things that come with it. You get the opportunity to have somebody else second look at, make sure it's done right. And you get this kind of protection, right? So I had a CPA who was preparing the return and, I get the return and I'm like, oh crap. And we owed $140,000.
Wow.
And I'm sitting back like, this is stupid. I can't believe I'm going to give this much money to the government. I'm pissed off because it was the most money I'd ever made. And to be honest, just like most people, I didn't have $140,000 sitting around, I was like, if I made that much money, where is it? You've been there.
Yeah, I hear you.
So I get to the end of, to the return and I'm like, crap, I don't know what to do. So I did what I thought was best. And I contacted a mentor of mine who was a CPA and a good friend of mine. And I said, hey, let's sit down. Can I take you to lunch or no, to dinner rather? So we go to dinner and I'm there. I'm like, hey, look, okay. I'm here because I need some help. And he says, what do you need help with? I said, look, I've got a tax problem, man. I owe a lot of taxes. He goes, how much? I tell him. And then he says, okay, so what you going to do? I said, well, what can I do? Can you help me? And he's a CPA, very respected guy, knows his shit, very good. And I said, help me. And he says, there's nothing I can do. And I said, why not? And he goes, the year's over. It's done. You're done.
Right.
And I said, well, yeah, okay, but there's got to be something. And he goes, look, man, there's nothing we can do. You just pay your taxes. And I said,
that's the answer you were looking for.
Yeah. I'm like, you're supposed to help me here, bro. And he says like, no, this is it. You're going to pay your taxes. And that's the end of the story. And I said, I don't want to pay my taxes. And he says, look, if you don't pay your effing taxes, what he told me, he goes, don't you dare vote next year. And I'm like, okay, I guess I'll pay my taxes. Right. So I leave that conversation with another epiphany, which was, I can't believe I put myself in this predicament. And he was right. I couldn't do anything about it. And I said, I'm never going to let this happen again. So from 2015 to 2020, all I did is kind of scheme and learn about how to avoid paying taxes for myself. I was very selfish in the sense that, because the majority of the customers I served at the time, by the way, didn't need tax strategy. They were middle America, not big, either very, very low tax liabilities or big refunds, right? That's who we served. And so those clients, I couldn't talk to them about, going to an S Corp anyways, we won't get into technicals, but I couldn't just ask them those things. So I was doing it for me. And in 2020, as the world shifted with the pandemic and everybody went virtual, I got exposed to a new business, which was, kind of business people like business clients who had big tax problems, who didn't know what to do, had horrible bookkeeping, who were really underserved. And so in 2020, from March on, I started to serve a different kind of client, but not because I chose it. It's like they found me. It was weird. Like I started to meet all these high net worth people who were, and it was just because I was posting things on social, like, hey, this is what you should do about this, or hey, I'm thinking this, or I'd just give advice and people would just come to me. And it was crazy. And so I kind of got exposed to some of the things that I had been doing for myself, I started doing for clients. And so that's when I kind of started to shift from tax professional or tax preparation to tax strategy. And so in 2020 and beyond, all I've done is help high income earners mitigate or eliminate their tax liability using strategies that are right in the tax code, and then helping them use that money to build wealth. That's really the goal. It's what I call tax flow. I help them find tax flow, and been doing that for about 3.5 years, and I really enjoy it. So that's how I got here today.
Yeah, and that's an important distinction. You said a couple words there like scheming and stuff like that. It's like it's really not like an avoidance of something that you legally have to do. It's planning ahead to take advantage of the laws that are on the books to strategize a way to avoiding is correct. Avoiding paying taxes that you don't have to pay legally if you plan correctly.
Yeah. Well, I mean, I always think about this. Those who know the rules rule, and the code was written to be used, not to be enforced, if you will. Like they don't, not knowing the code is just filing or just using whatever the software is going to say, right? Because code is written in language that isn't easy to understand. But if you understand it, it incentivizes you to do activities that the government wants you to take action on. And that's what it is. It's just basically playing by the rules. That's all we're trying to do. Play by the rules at a high level.
Yeah, and that's I hate to get into politics, but I'm going to get into politics. That's what people hear. Trump. He only paid X amount of dollars in taxes, or whoever. I mean, name whatever well-off person.
All politicians.
All wealthy people. Like they talk about how much they're not paying their fair share, whatever the hell that means, and it's not because they're doing anything illegal. They're looking at the tax code and they're working with people like yourself that understand it and can implement strategies to take advantage of it. And there's a mindset behind it. You kind of briefly touched on it of why the code is written that way. Can you kind of elaborate on that a little bit?
Well, I mean, first off, we have to understand who writes the code, right? Congress writes the code, which is, the people we elect. And as much as I'd like to believe that every single one of them had ambitions to go to Congress to change lives and make an impact in the world, trust me, I believe that wholeheartedly. Most of them do. However, when they get there and they have the opportunity to make adjustments to tax code that may benefit them and their families, I don't believe that they're like, oh no, we can't do that. Like they're like, hey, this sounds like a good deal for some people. And they get on the phone, hey, cuz, you ever thought about opening a business with windmills? I mean, this is happening, dude. So it's like these guys are writing the code so that they can play the game too. And it'd be naive, it'd be ignorant, it'd be stupid of us to believe that they don't write that code for that purpose. And so they're the ones who inadvertently put a code in place. And our job is to interpret that and find the direction that they're going. Because every time Congress passes a bill, in most cases, there's one alteration to tax code or emphasis in something that they want us to do. They either want us to invest in energy or housing or oil and gas or something, industry, job creation. All of these are incentives by our government. And what they're saying is if you use the code in the appropriate way and follow our instructions, you will benefit from it. Because to be ultimately, the truth is, when we do these activities, the government benefits from it. Like, even though they may not let me pay taxes, for an example, if let's say I avoided and I paid zero tax this year and my income was over $1 million, just use that for an example. For me to avoid taxes, I probably invested in either my business, which created jobs, which creates tax dollars, right? Or I invested in, let's say, real estate, which creates housing for people who didn't have housing before, which creates real estate taxes, which feeds our community, which maybe then employs people. And I mean, it's a domino effect that we don't see. So we just think, well, if they're just cheating taxes, they're cheating everyone. No way. If I get more money in my pocket, I probably put it more out into the economy rather than the government does it. Because if the government takes $1 from you, they put it into something and they get $1 out, because that's how they work. They can't figure out how to multiply because they just don't have the capacity. So if I give them $1, they use the dollar. You give me $1, I multiply it times 10 somehow, because I'm a resourceful business owner. I'm going to stretch that freaking dollar and I'm going to make something happen with it. And that's why the tax code was written this way.
Yeah, I think if you give the government $1, they're probably going to get about 10 cents worth of benefit out of it, not even $1.
You're probably right, right? Actually, they owe, you can't even give them $1. They already owed it, man.
That's true.
Here's $1 and it just goes out that way.
We're strictly paying down the debt. That's all we're doing at this point. So, I mean, that's, I think, something that's really important for people to understand about the tax code and why the government does it. Like, they might have certain goals or industries that they want to develop and promote, and that's why they write the code that way. So for people to look at, tax strategies or avoidance, as you would say, as a negative, it really just takes a mindset shift. It's not a negative. It's not that I'm trying to get out of something. It's the government is trying to incentivize me to do certain things to help all these other areas of the economy. It's my obligation, to do that, I think is the way you should look at it.
Yeah. This morning, so we're doing this challenge this week called the Pay No Tax Challenge. And we've got over 1,000 people registered for this thing. And it's cool because what I'm going to do is expose ideas and concepts that would get you to start thinking about how to get to the zero tax bill. But the reason I share that with you is we're running these ads and we're posting things, and I get comments all the time. And some of these comments are just idiotic, in my opinion. There's people that comment in there, they're like, it's my right to pay taxes, and I love paying taxes. And I'm like, I'm all for paying what I'm supposed to pay and not a penny more. That's just the way I am. But for you to say I had a guy tell me, oh yeah, I paid a $1.6 million last year and I've never been audited. And I said, it's because you're overpaying. Why would they audit you?
I don't want to find out you screwed up and you paid an extra $600,000 you shouldn't have paid.
I had one customer come to me one year and he was bragging about it. Oh yeah, I got audited 3 times, never found a penny, blah, blah, blah. And I said, it's because they went in there, bro, and they saw that you're overpaying and they said, hey, let's just get out of here before this guy figures this shit out. You know what I'm saying?
Best friend.
If you get audited and you pay something because if they find something, bravo, man. Because the truth is that is exactly what they were trying to do. If they don't find anything, it's because you're overpaying.
Yeah, that's. I never looked at it that way. That's definitely the right perspective to take on it.
And by the way, just to emphasize that, because that may sound a little crazy, but the IRS is not some big bad bully who's going to come with a baseball bat and break your legs if you don't pay them anymore. That's not how they work, man. You will have more trouble with the state government than you'll ever have with the IRS. I mean, state governments, agencies, if you owe them money, man, they will break your legs. But if, I live in Texas and like you forget to file a franchise tax report and they'll be at your house and shit. Like, this is that crazy, okay? But
Jeez.
IRS sends a nice little letter that says, hey, we don't agree with something on your tax return. Right. And then it'll say, like, here's what we don't agree with. And then it'll say, please respond within 45 days. So then you send your little response and they're like, oh, well, we need more information. You send your little response. Oh, we need more information. We send a little response. And then finally, like 6 months later, you might get a phone call. You get on the phone call and you're like, hey, what's going on? They're like, well, we reviewed everything and we have a disagreement. So, we said it was 15,000, but it's about 5. Okay, well, can we get to 0? No, we're going to go with 5. You know what? Okay, I'll pay you the 5 and let's go. Like, that's how easy it goes. That's literally how easy it goes. It's crazy.
Yeah. I think people are just afraid. They've heard enough stories that they've got the fear of the IRS, and it makes them not want to look into these things that are designed to benefit the economy if you take advantage of them.
Yep, that's how it works, man.
So let's kind of get to the real basics. Talk about the different types of business structures and maybe what the positives and negatives are of each of those different types of business structures.
Well, it just depends, right? So, and let's just keep it to real estate because this will be easy for everybody to understand. Is that real estate? So, first off, there's 2 ways to think about real estate, right? There's a tax side and there's an asset protection side, right? So there's these two things. Asset protection means protecting the asset from litigation or taxation. And then obviously this tax entity structure that protects you or that lowers or hopefully lowers your tax liability. So whenever I buy real estate, first thing I do is I put it into an LLC. Now this could be your flavor of the month, if you will, or however you decide it, but I like one LLC per property. And it's not necessarily just for taxes. We'll talk about that in a minute. But what I do like about it is it gives me a certainty of asset protection, right? Because if anybody sues me or that entity, it's only for that one property and not all my properties, as opposed to some people who put 20 properties in one LLC, or, you've got a wide range of asset protection or litigation opportunities. And so I start with one LLC, one property. That's what I do. And the tax benefits really are not huge, other than it gives me the ability to isolate expenses, isolate income. And typically I could use that money or proceeds and feed something else. Like I could feed a property management company that I own. And that could be an S Corp. An S Corp is a subchapter S corporation, which allows me to first and foremost avoid self-employment tax. Next, put myself on payroll. Next, allows me to have maybe a 401k or some sort of retirement contribution account. Lets me have a reimbursement plan. Lets me have the ability to use the money in a way that I most typically wouldn't. So I have a LLC that owns the property. I have an S Corp that manages the property. That's my formation structure whenever I create real estate transactions. That's how I'm always going to do it. Now, I don't create a management company for each property. I create a management company that manages all my properties. So it's just one management company and one LLC for each property. Does that make sense?
Absolutely.
So that's kind of an entity structure for real estate. Would you want me to elaborate on anything else? I mean, I can, but I'm just thought real estate would be cool.
Yeah, no, I mean, that's good. I mean, I think a lot of people don't necessarily understand the differences between them and how they're taxed differently, because some people might start doing something in a sole proprietorship and not realize the difference by having an LLC or an S Corp in terms of the tax benefits of those. People have probably heard of the protection aspect of an LLC. Maybe just touch on a little bit of why somebody should go into an LLC from a tax benefit standpoint, as opposed to trying to, handle their real estate in a sole proprietorship or just personally.
Well, there's not really, so LLCs don't have any tax benefits other than if you elect them to have a tax benefit. So a tax benefit could be S Corp, subchapter S. It could be C Corp, which is an actual corporation. These are elections tax. So think about an LLC as something that's not really recognized by the IRS. It's recognized by a state. Limited liabilities are established in states, not by the IRS. Now, when you found an EIN, which is an employer identification number, you actually tell the IRS, I am in an LLC in the state of Texas, because that's how they know it. And then in Texas, well, you say that. And then the next thing is, how do you elect to file? And you get to choose. Do you want to be a sole proprietor LLC? Do you want to be a partnership if you have more than one member? Do you want to be a subchapter S? Do you want to be a corporation? Or do you want to be a nonprofit? There's 5 filing statuses, if you will. And you get to pick the one that best suits what you're trying to accomplish. An LLC generally does not have a tax benefit per se. It has more asset protection benefits, unless you elect to use one of those filing statuses, such as S Corp or C Corp. Those are the only times, or a nonprofit, obviously, because you don't pay taxes. But you don't have a lot of an LLC doesn't really give you a ton of tax benefits, but it does allow for better bookkeeping. It does allow for asset protection. It allows you to start bank accounts in a better way. It allows you to keep some sort of delineation between you and any other activity. So those would be the benefits of an LLC.
Yeah, see, that's what happens when you ask a bad question. Yeah, I should have asked you the S corporation versus the C corporation versus the sole proprietorship taxation.
This is a bad question. I'm just letting you know. I mean, I really don't believe. I believe what you asked me really is a question most people have. Like, so what? Because I get people who come to me all the time. They say they need an LLC for tax benefits, and I don't think that's the case. Like, I always tell them it's not taxes you're trying to avoid here. It's liability protection. But to be truthful, most people don't even need an LLC because they have nothing to protect. I mean, I feel bad saying that, but most people come to me and they're like, David, I'm starting my new business. I'm like, okay, cool. What are you trying to do? I need an LLC because, I'm going to knock it out of the park. What do you got right now? Well, I haven't made any sales. I'm like, okay, cool. What do you got in assets? Well, I own my own house. Okay, what else? That's it. Okay, well. You got cash in the bank? You got big retirement accounts? What you got? None of that. Okay, well, you got nothing to protect, man. So LLC doesn't even need to be in place yet.
So what are some of the things that you see in the tax code that people, whether they're starting a small business or have a smaller business, maybe they're thinking about getting into real estate, what are some of those things that people don't understand about the tax benefits of real estate investment?
Well, I think a lot of people are scared of real estate because they think it's a big undertaking, right? And there is some undertaking, and I say this really gently, is that there's going to be some work involved with buying real estate. Okay, unless you want to be a passive investor, like in a syndication of sorts, you could do that. But for the most part, I like people to get hands on because you get the biggest returns this way. At least initially, right? Fast returns, because most investors don't like to wait around 3 to 5 years. I mean, that's the way you're supposed to invest. But if you're getting into real estate, most people hear this big word. It's called cash flow. And so they're like, I got to get cash flow this month. I hear my buddies making $500 a month. I have my other buddies making $1,000. So I got to be making that. And that causes work, right? So if you want to get into real estate, to just first off, just know you have to make a decision. Do you want to be a real estate entrepreneur, which is pretty much somebody who's going to actively invest in real estate and actually participate in the activities on a daily basis? Or do you want to be a real estate investor? There's two different terminologies for me. These are my terminologies. The investor, obviously not, but I call people who want to be in real estate entrepreneurs. So they're real estate entrepreneurs.
Right.
So once you pick a lane, this will determine exactly how much benefit you're going to receive. So just like a business owner would benefit from his business, a real estate entrepreneur benefits from their business significantly. They get to benefit from the income. They get to benefit from the tax deductions. They get to benefit from ownership of a business. You know, there's a lot of good activities that happen with a business. And an investor is just like you would think. They only get the upside, which is, you know, just cash flow if there's some. They get participation in an activity, but they don't actually materially participate. They're just investors. And it depends on what side you want to do. Now, depending on what side you're going to pick will determine how much you're going to win in taxes. Because an investor wins long-term, meaning their investment, well, their cash flow is typically tax-free, and typically they'll win 10 years from now. That's good. It's good. An entrepreneur can win today and 10 years from now because their benefits hit today. If you get a tax deduction for real estate today, it applies to your tax return today. Investors don't get those things. They just get the appreciation. They just get the cash flow, and that's it. The investor or the entrepreneur gets the cash flow, the appreciation, the depreciation. They get equity buy down. They get all these cool things that come with being an entrepreneur, which I personally love the most. But it just depends on what side you pick. And so if I had to say, to answer the real question, I guess in a simple way is, you know, some of the most common things that I get questions on is like, which side do I pick, right? Which one do I want to do? And then how much do I have to use of my money? And all those depend on your certain circumstance. But I believe that real estate is the number one vehicle, right, for wealth building, for tax deducting, and wealth building. Or did I say wealth building twice? Yeah, wealth building.
Wealth building is kind of important, it sounds like. Oh,
yeah. Well, I believe that, you know, here's an interesting thing that ties with real estate. Rich people pay taxes, wealthy people don't.
There you go.
That's just what it is. So you own a bunch of real estate and you're really wealthy, there's a very high likelihood you don't pay taxes. There's a very high likelihood.
And what is the main reason for that?
Well, because real estate gives you a tax incentive. See, the government, like I mentioned earlier, they have incentives built into the tax code for people who invest in things that they want. Housing is one of them. So the more you invest in housing, which is real estate, the more opportunities you have to have a deduction on your tax return. If those deductions are greater than your income, you pay no taxes, which can happen if you invest in the right strategies and you follow the system. So it's a great way to be in real estate, avoid taxes.
You want to buy a house, but high interest rates have got you down? Take the rate challenge and send us a verifiable loan estimate from another lender, and we'll beat it and pay for your appraisal up to $600. Here at Give Mortgage, being powered by UMortgage allows us to provide you with unmatched speed and efficiency and the best rates and fees in the market, all while delivering you the concierge level service you deserve. We want you to have an experience getting a mortgage that you'll never forget, and not because you got put through a meat grinder to get it. At Give Mortgage, we give great advice, we give the best rates, and we give back to charity. Visit us at www.give-mortgage.com or call us at 480-331-4684 to schedule a free consultation to see how we can help.
So getting back to your question, like the people ask you, you know, which route do you go? Do you go investor? Do you go entrepreneur? What are the criteria that a person has to look at individually to help guide them down that right path? Is it amount of capital that's available? Is it amount of activity they want to put into it? What's the things they need to look at within themselves to decide which lane to take?
Time. It's hours, because an entrepreneur has to meet certain hour requirements in order to get the benefits. So it's typically 750 hours in a year. And if you don't do 750 hours in a year, or you can't, it's typically not going to be your route. You want to be on the investor side. So either you're an investor or an entrepreneur, time is where it's at. When you hit 750 hours participating in real estate investing activity, specifically your own, now you have unlocked the code. You've actually found the cheat code, if you will. If you were playing a game, you went the up, down, left, right, and now boom, all the losses from the real estate and all the gains can get offset. It's a beautiful formula. So it's just time is the factor.
So it sounds like somebody that does have the ability to allocate a good chunk of time might be better off going down, not just that they have the opportunity, but they might be better off going down the path of entrepreneur because of all the additional benefits, right?
Correct. Typically what we like to, it's very hard for most people to be the entrepreneur, by the way. If you've got a full-time job, it's very unlikely you can do it. If you own a business and you're the manager, owner, CEO, whatever you call yourself, you probably couldn't do it. So it's typically going to be somebody, we usually like to use a spouse for an example. A spouse would really qualify. Like say my wife, for an example, is my real estate entrepreneur in our businesses. So I own a business, or we own businesses together, but she doesn't actually actively participate in them every day. She's managing our real estate portfolio.
That makes sense.
So she's an entrepreneur.
That's a good way to kind of differentiate it. If you've got a job that you're using to bring your money in, and you can be a business owner but not be actively managing it, just be an oversight, and then still have the capacity based on the hours to go the entrepreneur route, right?
You could, but it would be hard to justify to the IRS that you did 750 plus your 2,000 hours at your regular, business. Very hard to justify. Very, very hard. Unless you were a hands-off absentee owner, which is very rare in most cases. Very, very rare.
So what are some of the differences between different types of real estate investment that you see out there?
What do you mean by that? Say that one more time.
Well, what are some of the tax advantages, or is there a difference between different types of real estate, different types of property? So, for example, if someone's looking to do either a single family long-term hold investment versus an Airbnb versus multifamily versus commercial, like what are some of the biggest differences tax-wise that you see from those different types of investments?
Well, I think what I like to say is more doors, more deductions, right? More doors, more deductions. So if you have more doors, more deductions. So you would think about, let's say a warehouse, less doors, right? So less deductions, right? So more doors, multifamily. Single family, one door, if that makes sense. So what I look at is how many doors can I get under management, because that's where I get the most deductions. So I'm looking for multifamily. I mean, single family and Airbnb is probably the same thing. A duplex has 2 doors, a quadplex has 4 doors, and so on and so forth. So a real easy formula for me is just looking at how many doors does the property have, because that means there's going to be more opportunities for accelerated depreciation is what we're looking for.
Gotcha. And so what about some of the fears that people may have in terms of getting into real estate at this particular time with where interest rates are in the market? Everybody's complaining about how high interest rates are. How do you feel about that? Obviously, no one likes high interest rates, but should people be scared off from real estate investing based on where the current market is?
Well, I would say that first off, I mean, interest rates aren't that high. And I actually think it's a good thing. I'm not saying I like them, don't get me wrong, but we just got spoiled. We were just spoiled for a few years. And real estate rates were never that low before COVID, right? They weren't at 2s, they were 4s and 5s.
Yep.
I mean, we're a little higher than we were in a few years, but here's the deal. I think it's really going to cause our real estate market to be strong, because those who can afford to buy right now are really buying based on real market conditions, right? I mean, if you can afford it, that means that's a good thing. I hate to say it, it made it a little more unaffordable for most people. But I mean, and this is going to be very controversial, but this is the Uncensored, right?
Yeah, exactly.
Dude, in most countries, you got to put 20% down, right? In most countries, except for the United States of America, where you get to put 3% down, right? That's why if you buy an investment property, typically the bank requires 20% because that means you are a responsible buyer, right? So I'm just using this as an example to say that the rates are irrelevant. A deal is a deal, right? A deal is a deal is a deal. And I don't care what the rates are. I think that if you're looking at rates, it's because you're looking at the wrong deals. Like, look at a deal, and if it should make sense. Like, if it doesn't make sense, it doesn't make sense. I don't buy real estate just because I want to buy real estate. I buy real estate that gives me a return. Now, I may not get a huge return as in compared to years past, but I have to see a return. There has to be some metric to determine my return, meaning my ROI, my return on investment, or my return on cash has to be, let's say 8 or greater, or on investment or on cash, I would hope that it's greater than double that, like 16. Because if it's not, I probably won't do the damn deal. And that's what I'm saying. What I'm getting at is I don't think that it should hinder anybody. I think what it should do is just make you more conscious of what you're buying. Make sure you make good investments. I think the people today, not today, I think most people want to get into real estate have no effing clue how to get into it. And I get it. It's not like this is taught. But if you were to just take real estate out of the equation, just don't even pay attention to real estate and just think about an investment. So I'm going to put $200,000 into some sort of account. And that account, how much should that account turn back to me in return on an annual basis, right? Because that's what you're doing. You're putting $200,000 into something and you're expecting it to give you a return. If you could just use that formula, what your return should be, then the deal makes sense or it doesn't, right?
Well,
and you factor it in. What's that?
Yeah, and I think that's the thing that some people don't necessarily look at. They look at the cost of that asset. Let's say it's a $400,000 home, and they measure that $400,000 home on the return that they're going to get. But they're also not necessarily, I should say, more of a novice investor is not necessarily looking at the fact that, okay, you are buying a $400,000 home, but you're actually not spending $400,000 in cash on that property. You might be spending $80,000, $90,000, when all is said and done to get into that property because you're leveraging, you're borrowing, you're getting a loan against that property. And then you look at your returns, your cash flow. But the other thing that some people aren't thinking about too is you've got rents that you're measuring your numbers on today. You've got your cost of borrowing, your cost of your money today. But you've got to project down the road a little bit because we're a little higher than we'd like to be, ideally on interest rates today. But if you're a little higher on interest rates, even if you got a little bit of a negative cash flow situation going on, that's more deductions off of the rest of your income, right? And then next year, rents are going to go up. Your cost of borrowing is the same, or in all likelihood, based on the market's going, it's a good chance you might be able to refinance and actually lower your cost of funds and build that cash flow difference even higher. And that's the thing that people have got to look at. They've got to look at that long-term play. Sometimes we get so short-sighted and want to know what's it going to do for me this year. And they're not taking the tax benefits into account. They're not taking about the change in your income that comes with rental appreciation, the potential decrease in costs based on getting into a lower interest rate down the road. So, I think those are all factors that you would consider in an investment, right?
Yeah, definitely. Well, to be truthful, I'm not into this negative cash flow thing. So,
well, no, you don't want it for sure.
Well, I see the point in some properties, but to be truthful, if I can't go $1 positive, I don't want to do the deal. Just $1. I mean that because, I'm in a different situation. Here's a better way to state it. As long as I got reserves that can handle the negative, I'm okay. But the problem is that, I don't want to do that. That's what I'm trying to say. I don't buy deals unless I can get a positive number. Even if that means I'm going to come out of pocket more if there's something like for an example, this weekend. So we have a property, the cash flow is really good, about $900 a month, right? We're making about $900 cash flow a month on this property. It's a great property. I just sunk $3,000 into it this weekend for tree removals and branch removals and updating some things in the back and a fence that needs to be fixed. All of this happened because we had some bad weather, right? And just think about that. That's like 3 months of cash flow, right? Like I've lost it. Okay, fine. But what I'm getting at is those are going to happen. And what if I was already negative? What if my cash flow was negative 900? Then I still get a $3,000 bill. I mean, most people can't weather that storm.
Right.
Most people can't. I'm not saying that not everyone wouldn't do that deal. I don't want to weather those type of storms. I want to be cash flow positive. I'm not trying to make $1 million off every deal personally. I would just say, I wouldn't recommend it to anybody unless they had significant cash reserves. They'd have to have real big cash.
That's part of why, the more doors that you have, the more potential for positive cash flow that you have. That's where the numbers get a little tough to do now on a single family property in some markets. I know a lot of the investors that we're looking at, they're going for the Airbnb route as opposed to a long-term rental, because the long-term rentals, the cash flow is really, really tight. On a lot of them, Airbnbs generally can get a much better cash flow situation. But to your point, the more doors, the more income you got coming in, the more positive you can typically be, and turns into a better investment a lot of times.
Yeah, well, you could treat it just like a business, right? Like, so if you had a donut shop and you had 3 donut shops, right? And one of them could make a ton of cash, one could make a little cash, and one could lose cash. But if it's one business, right, it's cash, right? You're still winning as long as one of them is covering the other. You could just kind of say it like, my liabilities are still paid by somebody else's money.
Yeah.
And that would make sense to me. But if you don't have that luxury, I had a lady buy her first long-term rental recently who came to it. She's a new client. She was taught by somebody to buy real estate outside of her where she lives. She bought like real estate across the country because this is some cool idea. I'm not very sure why that's so cool. But then she tells me, yeah, I bought this property. It was $400,000. I'm using it as long-term rental. I'm losing about $1,500 a month. And I'm like, $1,500 a month? Why? Well, she goes, well, I mean, this is just part of the process. It'll appreciate, and then rents will increase. I'm like, rents are not going to increase by $1,500 a month. You know what I'm saying? Like, it's just not possible. It's just, I mean, maybe in 15 years, maybe it'll appreciate. But I mean, I'm like, this is dumb, dude. Somebody taught this lady that she needed to take a $1,500 haircut every month. And I felt really bad because whoever told her that was stupid. I mean, it was stupid. I didn't tell her she was stupid. I didn't tell her she was doing wrong. I said, hey, you might want to reanalyze your cash flow position there. And maybe you need to reanalyze it as an opportunity to make some changes. That's all I said, because I can't be a dick about it.
Yeah. Talk a little bit about, if you would, the advantages of using 1031 exchanges. I don't know if people really know a lot about them. I know we still see people, not taking advantage of them. That's kind of surprising.
Well, 1031 is just a way to kick the can down the road, if you will. I mean, so the interesting thing is that, so we like to, for an example, we like to buy properties. Everybody likes to buy properties and then use depreciation on those properties. So every year you depreciate a property by, typically if it's single family, it's 27.5. Let's use that in an analogy, or an example rather. So you got 27.5. So what happens is every year you just 27.5, you divide your purchase price by 27.5, and that's your deduction every year on your property, right? So let's say you hold the property for 27 years or 27.5 years. Now your property has depreciated with the IRS, and now you want to sell it, okay? Well, every dollar from zero is going to be taxed at capital gains rates, whatever gains they are at that point, because your depreciation lowers what you call your basis. So every time it goes down and down and down. So imagine if you bought this property for $100,000 27.5 years ago, and today it's worth $1 million. Because 27.5 years is a long freaking time. So it could be $1 million. So you got $1 million property now in California, and you want to sell it. Well, you're going to pay taxes on the $1 million. So instead of instead of paying taxes to avoid it, you take the $1 million and you roll it into a new property. And it's called the 1031 exchange. So you move it into a new property and you keep the money there so you can avoid the taxes. And now you start the cycle again. You buy a new property, you put $1 million down into it. Now you're going to start the depreciation cycle again on the new property. And your gain is in that property. So you're going to keep doing this if you want, literally, just to be honest with you, till you die. And the reason you're going to do it till you die is because whoever gets the property when you die, they get it at what they call stepped up basis. So all the taxes you've been avoiding for many, many years, they disappear when you die. So you just keep passing the can down the road if you can. If you can. I mean, I would. $1 million, you just keep putting into properties. Eventually, you're going to have a $20 million, you know what I mean, portfolio of some sort.
Yeah, and that's, I think, sometimes people don't realize is the benefit that you have with the stepped up basis, because if you've got kids and you're going to leave the properties to them, whatever you've accumulated, potentially to your children. Why do it where they've got a huge tax bill, as opposed to doing it where you can eliminate that tax bill using the stepped up basis benefit of the 1031 exchange?
Yeah. You just gotta wait till you die.
But you're not paying the bill every year that you're selling property. So
yeah. You don't want to pay bills. You just kick the can down the road. And then what you could do is you could buy a property in a let's say, well, O-zones is about to end, but opportunity zones would have been a good way to exit the 1031. There's other strategies to get out of 1031. I would say, to be truthful, capital gains taxes can be avoided in other mitigation strategies. So you don't have to necessarily be worried about it. However, if you really just want to avoid capital gains completely, you just do 1031.
Gotcha. So is there one thing that you can kind of leave us with as something that you would say kind of the most important thing that you would say most people don't understand about tax planning and strategies, or maybe just a sort of a quote unquote secret, strategy that most people don't take advantage of that they could take advantage of?
Well, I guess there's a lot of, you got a lot in that question. So here's just it, man. Right now, you're probably a high income earner watching this. And the reason I know that is because you're watching a show about real estate. You have aspirations, or you're already in real estate as a strategy, and this is great. You're probably making more money than you've ever made before. You're probably feeling good about yourself. You probably have some money on the sidelines and you're waiting to jump into the market at some point. And maybe you've been in an indecision mode for a while. I sat there for a long time myself. I call this the rich trap. I find when people make money and they don't know what to do with it, they're trapped. And then what happens while you're trapped is you wait probably too long and a year goes by, or at least a tax year does. And then your uncle, who's been your business partner this whole time, his name's Uncle Sam, he comes in and he says, hey, remember, we were partners and I'm owed 37% of that. And so he asked for his 37%, and you get what they call the rich tax, right? The rich tax, because you know why I call it the rich tax? Because only rich people pay taxes. And it's all really comes down to the reason you pay that tax is because, to be truthful, you just don't know, or you haven't taken advantage of the tax code. And it's typically because you're working with somebody who doesn't have an investment and a strategy behind helping you get somewhere better than paying taxes to get to the wealthy way, right? To get to wealth. And the way you do that is by having a tax strategist in your corner, not a preparer, not somebody who just does taxes. That I did for years. It's underrated. You don't need that. Anybody can do taxes. AI will be able to do your tax return real soon. They're obsolete. CPAs who just do taxes, obsolete. Tax strategies require somebody to actually know tax code and understand your specific situation and be intuitive to what could change in the future and what changes we can make today that could benefit you on your tax returns today and tomorrow and thereon. And a strategy not only encompasses code, but it also encompasses real estate as an investment strategy. I love real estate. We could talk about all kinds of strategies to invest. I'm just very, very heavily real estate oriented. I didn't mention this earlier, but along the way, I've acquired quite a bit of real estate. We have single family, multifamily, small multifamily. We have 80 doors, multifamily big syndication. We have 194 doors that's going to be going up in the next 3 months. So I really believe in real estate as a strategy, just to be clear. And so I think if you take this trap you're in, rich trap, and you really start thinking about strategy and investments, you can get out of there and you can build real wealth, and you can use real estate as that leverage point. But stop being paralyzed. Stop thinking that it's just you're supposed to pay taxes. That's bullshit. You're not supposed to pay taxes. You're supposed to build wealth for your family, and you're supposed to make sure that wealth is tax-free.
There you go. So that's the big secret, the big takeaway. Have a tax strategist help you make the plan to accomplish your goals. That's my takeaway anyway.
Well, I hope so, man. Thank you. That was a good one.
Well, if anybody wants to know more about what you do, maybe they think that you are the one that needs to help them get out of the rich trap. How do they reach out to you?
So you would reach out to me if you want to get a free consultation where we could review your current tax position and see if we're a good fit to work together. You can go to taxplanexperts.com, taxplanexperts.com. Also, in the coming weeks, we'll have a new book called The 3% Club, which is the 3% of taxpayers who pay zero federal income tax and make over $200,000 a year. On the Tax Plan Experts website, you'll be able to get it there. There's going to be a link that says register for the book. That'll be released in the next few weeks, but I would love to work with you in some way. If you are a high income earner who's got a big tax challenge, you hate paying taxes, and you're working with somebody who says, just keep writing checks, I'm your guy.
Sounds good. I'm sure you got a big section of people out there that fit into that bucket.
Let's do it, man.
Well, I appreciate all your time, David. I think this is great information for people. And again, if you guys are watching on YouTube, make sure you subscribe and hit the notification button so that you get notified when the next episode drops. And if you want to share this episode on your favorite podcast platform, please do so. I think a lot of people need this information that David's got. And David, again, appreciate you taking the time for us today.
Hey, thank you so much, man. Have a great day, everyone.
All right, take care.
Thanks for joining us, and please remember to go and subscribe, like, share, all that cool stuff to help us grow, and come back to listen to our next episode. Until then, go out and live life uncensored.
Thanks for listening to the Uncensored Real Estate Podcast. Don't forget to help us out and subscribe. Follow and give us a 5-star rating on your favorite podcast platform. And check us out on YouTube for the full video podcast. If you want more information on any of the topics discussed on today's episode, email us at uncensoredrealestatepodcast@gmail.com or give the Cardenas Mortgage team a call at 480-331-4684.